Let me tell you the most expensive sentence in real estate. I'm waiting for the market to come down. I have heard that sentence from clients who waited through 2012, 2015, 2018, and 2021. Every single one of them is still waiting. And every single one of them is worth less in real estate terms today than they would have been if they would have simply acted.
I have a client, I won't use her name, who told me in 1987 that she was going to wait for the right moment to buy her first investment property. She is still waiting. The market has tripled since then 3 times, and she is a smart, capable woman who made one very human mistake. She confused caution with strategy.
Welcome back to Wealth, War, and Real Estate. I am Natalie Francinne.
And I'm Alexis Nassif. Today we're going to dismantle the myth of market timing and replace it with something that actually works.
Here is what is true about real estate markets. They cycle. They always have. They always will. Prices rise, they plateau, they correct, they rise again. This is not a secret. This is not a crisis. This is the nature of the asset class. What changes, what determines whether you build wealth or miss it, is not whether you time the cycle perfectly. It is whether you are in the market at all.
I want to add a number to that. Studies of long-term real estate returns consistently show that investors who tried to time the entry points underperformed investors who simply bought and held by a margin of 30 to 40% over a 20-year period. Wow. 30 to 40% for trying to be clever.
Alexis, you have been in this business through 8 full market cycles. Walk us through what you actually saw.
I want to start with 1979, when I entered the business, because it is instructive in a way that most people do not appreciate. When I started, interest rates were heading toward 18%. 18%. Most people today cannot imagine financing a home at 18%. And yet, people bought homes then. They built equity. They created wealth because the alternative, waiting for rates to fall, meant not being in the market. And the market did not wait for them.
What about 2008, Alexis? That is the cycle that everyone points to as the argument for waiting.
2008 is the exception that proves the rule, and it is consistently misunderstood. Yes, values fell dramatically in certain markets. Yes, people who bought at the peak in 2006 or 7 with bad loan products on overvalued properties suffered. But, and this is critical, people who bought in 2009, 10, and 11 at the bottom, that correction, they made the best deal real estate in the last 30 years. The same people who said, I told you so about 2008, were also the people who were too scared to buy in 2010. They missed both the lesson and the opportunity.
If timing the market is the wrong frame, what is the right frame? What should someone actually be looking at when they make a real estate decision?
3 things: supply, demand, and your own financial position, in that order. Supply is simple. How many properties are available relative to how many buyers want them? When supply is low and demand is stable, values hold and appreciate. When supply floods, as it did in 2008, values correct. Watch inventory numbers, not headlines. Demand is more nuanced. It is driven by employment, population, movement, and interest in the specific area you are buying in. Not the national news, not the stock market, the specific market where the property sits. And your own financial position, this is the one nobody talks about honestly. is the most important factor of all. A great market means nothing if your financing is fragile. A strong personal financial position means you can weather any market cycle.
So the question is never, is it a good time to buy? The question is, am I in a position to buy well and hold strategically?
Exactly. And the answer to that question changes your entire relationship with the market. You stop watching CNBC for permission. You start making decisions based on your own readiness.
I want to go deeper on why people wait because I don't think it is actually about market analysis. I think it's about something else.
Fear, dressed up as strategy.
Say more, Alexis.
When someone tells me they are waiting for the market to correct, what they are saying, almost always really saying, I'm afraid of making a mistake. I'm afraid of committing. I'm afraid that the moment I buy, the value will fall and I will have been wrong. The fear is completely understandable. Real estate is the largest financial commitment most people ever make. Of course, there is fear, but here is what I have watched fear cost people. Every year of waiting is a year of equity you did not build, a year of appreciation you did not capture, and a year of rental income you did not generate. The fear of being wrong has a price, and it compounds.
And for women specifically, I think this fear has a particular texture because we have been told directly and indirectly that financial boldness is not for us, that we should be cautious, that we should wait for someone else to validate the decision. That story has cost women an enormous amount of wealth.
I have watched women with perfect instincts second guess themselves out of extraordinary opportunities because they were waiting for permission that was never going to come. The permission is yours. It has always been yours.
So let's make this concrete. If market timing is the wrong strategy, what do people who consistently build wealth through real estate actually even do?
They buy with a long horizon, not 5 years, 10, 15, 20. Real estate rewards patience in a way almost no other asset class does. They buy below market when possible, not by trying to predict the bottom of a cycle, by finding undervalued properties in fundamentally strong markets. Probate sales, divorce sales, estate liquidations. These create opportunities in every market condition. They buy with strong financing and conservative leverage. The people who lost everything in 2008 were almost uniformly over-leveraged. Strong investors hold enough equity that a correction does not threaten their position, and they reinvest. They do not sell on cash. They use equity from one property to acquire the next. That is how a single well-chosen property becomes a portfolio.
And the mindset underneath all of that?
Patience, conviction, and the complete willingness to ignore the noise, the news cycle, the predictions, the people at a dinner parties who tell you the market is about to crash. The market has been about to crash for every single year of my 45-year career. Mm-hmm. And in that same career, real estate has built more middle class and upper class wealth than any other asset in American history. I tell you.
Amazing, seriously. And I want to talk about something specific to women in this context because the market timing trap hits women harder. And I think there is a reason for that.
The reason is that women have been systematically excluded from the confidence that comes from participation. You cannot be confident in financial decisions you have never been invited to make. I grew up watching my mother defer every major financial decision to my dad. not because she was not intelligent. She was the most capable person in that household by almost any measure. But she had been taught that money was not her domain. That lesson is inherited, and it is expensive.
Research on women and investment consistently shows that women are more thorough researchers, more disciplined about fundamentals, and more patient with long-term strategies than male counterparts. These are all extraordinary advantages in real estate. The gap is not ability, it is the confidence to act on that ability.
And I will tell you, from 4.5 decades of this being on this table, the women who close that gap, who decide that their analysis is valid, that their instinct is trustworthy, that they do not need a second opinion from someone who knows less than they do, those women build extraordinary things.
What is the single decision that you have seen change the most women's financial trajectories?
Buying their first investment property alone, without a partner's income, without a partner's approval, without a financial advisor who tells them it is safe. I have watched women make that decision, and I have watched their entire relationship with money change. Not just the asset, the relationship. They stop seeing wealth as something that happens to other people and start seeing it as something they build. The first investment is never the most profitable one. It is always the most important one.
And for women listening who are not there yet, who are still waiting the place, what do you want to say to them?
I want to say the market will never be perfect. Your finances will never be perfect. Your knowledge will never be complete. At some point, you have to trust what you know and move. The people who wait, the women who wait for perfect conditions are still waiting. The women who moved on good enough conditions with solid foundations and long horizons are the ones calling me for their second and third investment properties. That's a smart woman.
Let me give you a practical framework, not for timing the market, but for evaluating any property in any market condition. Step 1, define your holding period before you make an offer. If you cannot commit to holding this property for at least 7 years, reconsider the investment. Step 2, stress test your financing. If interest rates rose 2% tomorrow, could you still carry this property? If your answer is no, your leverage is too high. Step 3, evaluate the market fundamentals, not the headlines. What is the job market like in this area? What is the population trend? What does supply look like over the next 2 to 5 years? Step 4, calculate your returns conservatively. Not what the market might do, what the property will generate at the current rents with conservative assumptions. If those numbers work, the deal works regardless of the market timing.
And step 5, the one most people skip, have an exit strategy before you enter. Know under what conditions you would sell, what conditions you would hold, and what conditions you would refinance. Investors who build wealth have an answer to those questions before they close.
The episode takeaway in one sentence.
Stop asking if the market is right. Start asking if you are ready.
And Alexis, the lesson from today?
The market does not owe you a perfect entry point. Your job is to be ready when a good one appears and to recognize that good enough with strong fundamentals and a long horizon almost always beats perfect on paper that never happens.
Next week, what luxury really means. And I promise you, it is not what you think. I am Natalie Francinne.
And I'm Alexis Nassif. This is Wealth, War, and Real Estate. Next week, I want to challenge something. Most people think luxury real estate is about price. I am going to show you why that is exactly wrong, and why understanding what luxury actually means will change how you approach every real estate decision you ever make.
Thank you.
Bye-bye.